Welcome to Traders Corner. As always, I'm joined by Garth McKenzie, founder and editor of Traders Corner. Garth, welcome.
Hi, Julieta.
Garth, it's interesting to see that the all-share go above 50,000 points for the first time in a long time. But we're going to talk about the top 40 to start with in this show. And it's been very, very range-bound. So I don't know if you're seeing any sort of breakout there. What's it looking like?
Yeah, we often start the show with a look at the top 40, and I know that we've done this many weeks in a row now, and I'll look at it again, and I know there's probably viewers that are out there saying, boring, we've seen this every week, but it is, nevertheless, it's interesting to look at. It's boring because it's really been very, very range-bound for the year to date. But having said that, it's range-bound in a very broad range. Now, the chart of the top 40 index that I've got up on the screen at the moment shows the trading action over the last 2 years or so. And you can see quite clearly there that big lateral level of support at 41,500, which we've mentioned so many times on this show. More recently, what we've got is this pattern that's really been in place since the beginning of 2016. In fact, that boxed area that I'm showing on the chart there, I'm going to zoom in on that in a moment. But that's really been the trading action for 2016 for the year to date. So for 2 months, you can see we've just been going up and down, up and down, up and down, not really making much headway either way, really. And I still look at that and I say, I wonder if that isn't potentially setting up a bear flag that ultimately does break to the downside. It might be, it might not be. I think we're going to need to let it play out and give it some time to see what it actually ends up being. But I want to zoom in on that, as I mentioned, and just show you, looking at that trading action for the year to date more clearly and with a closer look at it. There you can see it on this graph. Now, obviously, this is a daily graph, so every, what we could call a bar on this bar graph, is 1 day's worth of trade. And that big white line on the left there, that's the start of 2016. Okay. So that's the trading action since January into February. Now we've got 2 months of trading action for the year to date. And you can see really we've just had 41 trading days of sideways choppiness on this market for the 2 months of the year to date. It's been ranging between around about 42,000 at the lower end up to about 44,500 on the upper end. So that's still a 2,500 point range, which is decent. I mean, that you're talking about just over a 5% trading range on the top 40 there. But it's been very, very choppy, and we haven't made any gains really for the year to date.
I suppose a real critic of the show could say, yeah, it's been decent. So you talk about 5% ranges. Why haven't you been able to, I suppose, profit of them? Yeah. So, why haven't you been rallying with the rallies and maybe shorting the falls?
Well, that's right. And I can fully understand somebody saying that, because you're right. You look back at that and you say, but that surely should be a trader's dream to have that kind of volatility. There's plenty of movement within that range to capitalize on. Look, from my perspective, it is easier to trade a trending market that's got some direction to it. Because what we're finding is from 1 day to the next, you can go from being bullish to bearish to bullish to bearish. And it's very difficult to know in this type of choppy environment. What I do think, though, is that you need to drop your time frame on the graphs to look at for trading opportunities. And that's what we're going to be doing with this week's trade. And I'm going to show you an example of that. And it's a trade that we've done for this week's show. Because it's no use me coming back here week after week and saying, oh, but it's so choppy and it's so volatile and we're trying to preserve capital and all. I mean, yes, we are. But at the same time, we do also need to adapt to the market, because you can't just stand back forever and say, okay, well, this market's too tough to trade. Now we're going to just stand back and just sit in cash. I mean, that's not what we're here to do. So I think the key to this type of market is drop your graphs, drop your time frame on your charts. Look at more intraday graphs. So we're going to drop down to a 30-minute graph, for example, on the stock that we look at today. Now, I know that this is more specialized, and for the average viewer out there who probably has a day job and doesn't have time to sit in front of the screen all day watching the market all day, every day, it becomes a little bit inaccessible to trade off an intraday graph like that and to really drop the time frame down. And for this TV show, I always try and portray things in a way that I think that a viewer with a full-day job could probably still take the types of trades that we're doing and trade off daily graphs. But in this kind of trading environment now, it's not easy to trade off of the daily graphs because there's no major direction really to benefit from. So dropping a time frame certainly is beneficial.
Okay, we'll get to that. I mean, just maybe one last point there. The average true range, which I think, or the average traded range, I know that you wanted to talk about that as well, because that shows to the extent that the market can swing back and forwards and catch you out.
Yes, that's right. I've got a graph of the average true range here, which what the average true range here, and this is a 10-day average true range. What it does is it plots the difference between the day's low and the day's high. We call that the trading range for the day. And it looks back over a 10-day period and says, right, what's the average range been for the day, but over a 10-day period? And it's quite interesting to look at this. And what you can see, the numbers on the left and right of the graph here, if you can see those, are in hundreds of points. All right. Now, what's evident here is that from the beginning of January 2016, the average true range has been north of 900 points per day on the top 40. Now, I mean, to put it into context, when you've got a top 40 that's trading around about sort of 43,000, 44,000, that's telling you that the average daily movement for the top 40 index has been 2% per day, and it's been like that right from the beginning of this year, since the beginning of January. In context, last year in August, where we had massive volatility, the market had a big sell-off. We spiked up to that sort of area briefly, but we didn't stay there for very long, and then the volatility dropped again. But now we've been at this elevated level of the average true range for 2 months on the JSE top 40, which is quite unusual. So in addition to that sideways choppiness that we've been talking about, you've also got these huge intraday trading ranges, which, again, I say, you could say for a trader, well, that should be manna from heaven. The problem with it is that this type of volatility, it gives you one of two outcomes. Either you're going to, you can get it right and you can get it very right, or you can get walloped by that volatility and you can literally get your head taken off. And it's quite difficult to trade in that type of an environment because of that extreme choppiness.
Because it's almost completely uninformed. I mean, as you say, from one day to the next, the market could be bearish, it could be positive.
That's it.
You might as well just take out your darts and stuff.
Yeah, it goes from bullish to bearish to bullish to bearish quite quickly. And also what's difficult in that type of environment now is the big overnight gaps, because it's been very common this year to go out, close the day on the JSE looking like things are bearish, and then you come in and overnight the S&P 500 has rallied 40 points. And suddenly you wake up in the morning and the top 40 opens 700 points higher.
Yeah.
And vice versa. You can come in one morning and suddenly the market's been bearish overnight. It gaps down 700 points. Now, that's very difficult. That type of slippage can be enormously detrimental to your profitability as a trader. So it also does make one tend to want to sort of stand back a little bit and be careful.
Okay, well, in that context, and you talk about overnight moves, I mean, that's really short-term trading, but you're going to actually go shorter term. But before we do that, I know that you just want to have a quick look at the S&P 500.
Yeah, just still looking at our bigger picture. I like to always look at the S&P 500 each week as well, because this is also very important, being the largest equity index in the world. And we do tend to take our cue from this to a large extent. Just something I've noticed here, which has been interesting for the year to date. So again, starting in January, so that's the beginning of January 2016 over there, just the volume has intrigued me here. Notice how on the way down, where we've seen this S&P 500 falling, we've had rising volume into the selling pressure. Then when the market's been rallying, we've had declining volume. Again, when it's been falling at the beginning of February, we saw the market falling, we saw the volume climbing. And now, most recently, we've seen the S&P 500 picking up a bit, but the volume's been declining. That is not a particularly healthy volume situation. Ideally, you want to have strong volume on the up moves and weaker volume on the down moves. What this, to me, suggests is that there's more selling happening on the way down and not as much buying happening on the way up. And when you talk to that in terms of distribution or accumulation of shares, this is more a pattern of distribution, which is not really ideal from a bullish perspective. I would almost say this is something to be quite cautious of from a bearish perspective.
Well, I mean, it certainly seems to suggest a lack of conviction of the buyers.
Yeah, so. Very much so. It's definitely a lack of conviction on the part of the buyers, but there also seems to be more assertion on the part of sellers when the market is trending down, which is a little bit concerning. It's just something I thought I'd note because not often do you see volume patterns as clear-cut as this. And this one, certainly for me, is not a great-looking story because of the fact that you've got accelerated volume on the way down and decelerating volume on the way up. But in terms of this chart of the S&P 500, if we can get out above this 1950 sort of area, then it opens the way for this market to move up to 2,000. That would be the next area of main resistance. And then we'll have to see from there whether it can get any higher or not. But I think in the near term, if we can get above 1950, then it opens the way to 2000, and let's see what happens from there.
Okay, guys, so that's the bigger picture. But you are enacting a trade for the portfolio, and it's a share that came out with results yesterday. That was Bidvest.
Yeah, it's Bidvest, and this is in line with what I was saying earlier about having to drop your time frame. Because Bidvest, if you look at a daily graph of Bidvest, it's been also very, very choppy. It's been all over the place for the last month or so. Very, very choppy share. Now, this is a 30-minute graph, and it goes back to the 9th of February, so what we've got about 3 weeks' worth of trading history here. Every candle pattern that you see on this graph represents 30 minutes worth of trade. So obviously we're going into the intraday graphs here. We're not looking at an end-of-day graph as we typically do. And what I want to show you here is that there are opportunities to trade and to make money off of these intraday graphs if you are dropping your time frame and looking for these types of opportunities. So there's been a number of patterns, and I'll just point a couple of them out on this Bidvest graph. Now here you can see quite clearly on the 9th of February, leading out into the 11th of February then, a very nice clear-cut bull flag pattern over here. You take the height of that bull flag pattern, the flag pole, and then you project that distance up once it's broken out, and there you get your target. And sure enough, if you had have bought on the breakout of that bull flag pattern on the 30-minute graph, it got to your target. There was nice money to be made there. Again, more recently, on the 15th of February, another large bull flag pattern played out. And here you can see that, again, you take the height of your flagpole structure, project it up, and it reached the target from that. So again, if you were trading off of this 30-minute graph, there was an opportunity to trade that flag pattern, and there was some money to be made. More recently then, there was, on the way down, there was a little rising wedge pattern over here, which broke to the downside, as a rising wedge typically does, and again, it went lower. There was about 10 Rand per share to be had on the way down. Now, most recently, and this is where we get our trade for this week, is that the share rallied from the 25th of February. It's now been forming a bull flag pattern, and it started to break out to the top end of this pattern today. So in a strict technical terms, you take the height of that flag structure, that flag pole, and you project that distance out from the bottom of the flag. It gives you a target of about 370 Rand per share. So on this basis, I've enacted a trade today. It's a small trade, but using this 30-minute graph and taking the cue from what we see here with this bull flag pattern. So I've gone long this morning at 360 Rand per share on the breakout through the top of that flag pattern. The stop loss I'm going to use below the bottom of that flag structure, which is at 354 Rand, and I'm looking for a move up to the 370 Rand level here. The red and green box indicates the risk to reward ratio. So here we've got the red indicates the difference between where we go into the trade and where the stop loss would throw us out, and then the reward is the target minus our entry point, which is 360 Rand.
Yeah, it looks fairly decent. So just in greater detail, as you normally do, can you talk us through that trade with some of the other metrics?
Yeah, so we've gone long at 360 Rand. The stop loss is 354 Rand. The risk per share is 6 Rand per share. The risk, I'm risking 2,440 Rand, which is 1% of our account. We've got 244,000 Rand in our account, so 1% of that is 2,440 Rand. All right, then we take the risk per share, the capital risk, and we divide it by the risk per share. It gives us 406 shares, or 400 CFDs, I'm rounding it down to. So that's a reasonable size of trade to take. My target here is 370 Rand. So looking for that bit of upside. It's not a phenomenal risk to reward ratio, but I think it's worthy of taking this trade anyway, given that we do, we're trading on an intraday graph here.
Yeah, and 1% of the account or the capital. I suppose this is now you want to start hitting those singles in cricketing parlance.
Yes, that's it. Yeah, we're hitting the singles and really to keep the portfolio ticking over, but we're not taking excessive risk, because I'm still very conscious of the fact that our number one priority as a trader is capital preservation. And in this type of market, I think it's important to preserve capital. And
Garth, that's how the portfolio ends this week. So not too unchanged from last week.
Yeah, just shy of 244,000 Rand. So we're still down 2.5% for the year to date. But those are the positions we've got open. Our latest position being this trade on Bidvest, and we'll report back next week on how that's worked out for us.
Okay, we'll leave it there. Garth, thanks very much. As always, Garth McKenzie is founder and editor of Traders Corner.